Money is more than numbers on a balance sheet. It's a reflection of decisions, habits, and mindset. While anyone can earn a paycheck, the difference between wealth accumulation and financial stagnation often comes down to psychology. Understanding how rich people think about money reveals a blueprint for smarter financial decisions. And it's not just about having more, it's about behaving differently with the resources you already have. The first insight from research is that wealthy individuals focus on long-term outcomes rather than short-term gratification. Studies from the National Bureau of Economic Research show that high-net-worth households are significantly less likely to engage in impulsive spending, with the median wealthy individual allocating over 30% of income toward investments and savings, compared to just 10% to 12% in the average household. This forward-thinking mindset creates compounding advantages over time, turning consistent, disciplined decisions into generational wealth. One of the most striking psychological traits among rich individuals is their ability to separate emotion from money. According to behavioral finance research, emotional spending, making decisions based on fear, pride, or social comparison, accounts for a significant portion of financial mistakes in the general population. In contrast, wealthy individuals often employ mental frameworks to remove emotional bias, relying on objective criteria like return on investment, risk assessment, and opportunity cost. For example, a 2023 study by the FINRA Investor Education Foundation found that high net worth individuals were 42% more likely to research investment decisions thoroughly and diversify portfolios rather than chasing trends, demonstrating how emotional discipline directly correlates with wealth growth. Another critical principle is the understanding of risk and reward. Wealthy individuals tend to view money as a tool to create more money rather than a symbol of consumption. Research from the University of Chicago Booth School of Business indicates that affluent investors often tolerate calculated risk in stocks, real estate, and business ventures, leveraging strategies such as portfolio diversification, tax-advantaged accounts, and long-term compounding to maximize returns. By contrast, middle-income households tend to overestimate risks and underutilize opportunities, with 61% avoiding investments they perceive as volatile, even when historical data shows that moderate exposure could yield substantially higher returns over decades. This contrast highlights the psychology of financial confidence and strategic risk-taking that separates wealth-building behaviors from standard financial management. Frugality and strategic spending also define the psychology of money among the rich. Contrary to popular perception, wealth is rarely about extravagant consumption. It's about prioritizing expenditures that enhance future financial security or opportunity. A 2022 survey by Fidelity Investments revealed that 78% of self-made millionaires live below their means, often investing the surplus into income-generating assets rather than luxury items. This principle aligns with the concept of conscious spending, where every dollar is evaluated for potential return or value creation. The psychological skill here is patience and delayed gratification. Wealthy individuals consistently choose long-term gain over immediate satisfaction, a habit that fuels both financial growth and resilience against economic shocks. The role of knowledge and continuous learning is another hallmark of financial psychology among the affluent. Studies indicate that high-net-worth individuals dedicate significant time to financial education, analyzing market trends, tax laws, and investment strategies. According to a 2023 report from WealthXX, 72% of millionaires actively consult with financial advisors, read investment research, or participate in educational programs at least monthly. This proactive acquisition of knowledge allows them to make informed decisions, anticipate risks, and capitalize on opportunities before the broader market recognizes them. It's not just access to money, it's access to information and the ability to act strategically that separates the financially successful from the rest. Behavioral frameworks also play a central role in wealth accumulation. Concepts like mental accounting, goal-oriented budgeting, and automated savings reduce cognitive load and increase consistency in financial decisions. Research in behavioral economics demonstrates that individuals who automate their investments allocate specific funds for long-term goals, and avoid frequent portfolio adjustments achieve higher long-term returns. In other words, wealthy individuals design systems that align with their psychology, minimizing errors caused by human bias, impatience, or distraction. This systemic approach to money management creates a compounding advantage where consistent, intelligent choices amplify wealth over decades. Tax strategy and legal structures are additional components of the psychology of money. According to IRS and financial consultancy data, high net worth individuals often utilize legal entities like trusts, LLCs, and tax-advantaged retirement accounts to protect assets and optimize tax efficiency. Strategic tax planning is not merely about saving money in the short term, it's a mindset that views every dollar spent or saved as a lever to maximize wealth accumulation. Studies show that individuals who employ structured tax planning can increase effective wealth accumulation by 15–25% over a lifetime, emphasizing that smart money decisions extend beyond spending and investing into legal and structural frameworks. Networking and social influence further amplify wealth psychology. According to research from Harvard Business School, wealthy individuals are significantly more likely to leverage relationships with mentors, industry experts, and peer networks to identify investment opportunities and business ventures. This psychological inclination to seek guidance, validate decisions, and co-invest allows them to minimize mistakes and scale wealth faster than those relying solely on individual judgment. Wealth is therefore not only a product of individual financial intelligence, but also of strategically leveraging social capital to enhance decision-making. Finally, resilience and adaptability define the mindset behind smart money decisions. Market fluctuations, economic recessions, and personal financial setbacks are inevitable, yet wealthy individuals consistently demonstrate psychological resilience, viewing downturns as opportunities rather than threats. A 2021 study in the Journal of Behavioral Finance found that investors with higher emotional intelligence were 33% more likely to recover from market losses and adjust strategies proactively. This ability to remain calm, rational, and focused under stress allows the wealthy to preserve capital, capitalize on market inefficiencies, and accelerate growth even in volatile conditions. In conclusion, the psychology of money among the rich is a sophisticated blend of long-term focus, emotional discipline, calculated risk-taking, continuous learning, strategic systems, and resilience. Wealth is not merely a reflection of income, but of habits, frameworks, and decisions optimized over time. Understanding these psychological principles allows individuals at any income level to make smarter financial choices, minimize costly mistakes, and leverage resources effectively. From prioritizing investments over consumption to structuring finances strategically, the lessons drawn from wealthy behaviors provide a roadmap for anyone seeking to optimize their relationship with money and build sustainable wealth. For viewers who want to learn the cognitive and behavioral strategies behind financial success, make sure to like this video, subscribe to our channel, and hit the notification bell. We'll continue to break down the science, data, and psychology of money, revealing how smart decisions, rather than luck alone, create lasting wealth and financial freedom. By understanding how the wealthy think and act, you can transform your own financial mindset and start making intelligent decisions today that compound into life-changing results tomorrow.